question. Indeed, we witnessed in the first quarter, and particularly in mid-March, an unprecedented drop in the price of oil. I think the two events that happened, as most people know, has been that demand was severely affected by the COVID-19 spread, particularly for transport fuels, for cars and planes, so gasoline and jet fuel. And supply was further affected by the price war that emerged between the suppliers. But what we've seen recently is that this has exacerbated because demand has dropped to about 30% of what it normally is. And therefore, we've seen indeed the amount of inquiries globally to increase. That happened at the end of March. So I would expect that in the months following, particularly the second quarter, we'll see occupancy rates at storage terminals go up significantly.
What does that mean in terms of pricing? Because as we see storage facilities brimming with oil, there have been reports that tanker storage has gone up, but those prices escalating very rapidly. Have you increased your prices because of the increased demand?
Well, it depends very much on your starting point. I think Vopak is slightly differently positioned because our strategy has worked, and we have a strong portfolio of terminals across different liquidities and different products. I think 30% of our earnings are oil related, and 60% is gas and chemicals and industrial related. And second of all, we already had a high occupancy, whereby most contracts that we had with customers was there to supply more structural needs in nature. So I would say that Vopak is influenced by the price of oil, but we're not dependent of it, and therefore this market structure is seen as sort of a good support of our earnings. So the companies that had a profile which had low occupancy obviously could benefit better from the situation.
Okay, sorry to interrupt you just there. Look, we're looking at the oil complex, of course, and seeing can it happen here, can it happen on Brent, and Jeff's already been talking about that with our guests previously. What I want to ask you is, can it happen in other products as well? You have storage for LNG, liquid chemicals, gases, biofuels, vegetable oils. Because demand has dropped across the board for a whole host of these products, could what we're seeing in the oil market happen in other products?
Well, I would not expect that, because I think the situation at this moment in the United States is rather unique. I think logistically, the availability of tankage was such that with the settlement of the contracts in May, I think basically traders capitulated in the face of limited access of storage. I think we haven't seen that happening to Brent. I think that's still traded at $25 yesterday, and I see that the future contracts for June are again priced at $20, meaning the contracts or the markets actually anticipated supply will adjust. So I think what will happen is that producers need to respond probably quickly to this happening, and I think that will happen. So I think that we see this happening more often across the globe, I think is unlikely. But again, this is such an unusual situation. I think I've said it before about multiple things in the last quarter.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.